Hello my fellow investors. In this video part 2, I'm going to start crunching the numbers of DHC. So I put in all the information from all the data from 2002 until the current data. So let's start by the revenues. So in 2002 they had 122 million in revenue, and let's just go to the net revenue of 50 million. And we'll see they don't have a very big growth, but slowly throughout the next 20 years they've grown pretty much. So 2003 45 million, 56 million, 58, 66, 85, 106, 109, 116, 151, 144, 155, 153, and here starts the problems. 2015, okay, still 88. Next year they had 208, but we'll see here when COVID hit, that's when the numbers really got bad. And even so, we'll see in 2001 that they had a revenue of 174 million. That isn't their real revenue, but it's just they sold a property, and that's what, and they put it inside their income statement. And actually they lost also in that year. So you can say more or less that they started having problems in the past, especially since the pandemic hit, but even before that. Now, what's very nice in DHC was the net margins, and here we can see a bigger difference. The net margins since 2002, their revenue was 122 million, and their net margin percentage was 41%. In 2003, 35%, 38, 35, 36, 45, 45, 36. So basically, it's pretty nice, you know. It's a real estate company. They're renting out all their properties, and their expenses aren't so much. And the numbers really, we can start to see the difference is in 2012. 22%, 20%, 18%, 8%, 19%. So over here, we can see from 2012, for some reason, the net margin started going down, and we'll get that into these numbers more in the next video, in the third part. So from the revenue perspective, everything was pretty good until 2012. Even after 2012, the company was still earning very nicely. Once the pandemic hit, that's when things went really crazy. So this is from the revenue part. Now, I put in here SG&A, the selling and administration, all the costs, but the truth is DHC doesn't have any employees. All their payments for SG&A is all the fees they're paying for RMR and the companies that are managing their real estate. They don't have any employees, but still that's their expenses as taking care of all their properties, all the real estate. So that's their SG&A. Now, there's something I like. If we look only at the revenues, and so we'll get the numbers of net revenue of 50 and 45, like I said before. Well, if we go into net operating cash flow, and I mean just net operating cash flow without expenditures and everything, the numbers are even better, because in the net operating cash flows we're taking out depreciation. Now, as a real estate company, all their income is from the rents, and they're taking off every year the depreciation, but actually the numbers aren't really going down, because depreciation is just a amount you're assuming the property is going down and its worth. But if we see the net operating cash flow, the numbers are much higher: 99 million, 79, 95, 104 compared to 58. Then we have here again 116 compared to 66, 135 compared to 85, 184 compared to 106, and the net operating cash flow is much better. 255, we'll see. And even when since 2008, when we see the net margins going down, but the operating cash flow is still going up. And that's also a nice thing. 306, 350, 405, 426, 407, 392. So that's also another thing. As a real estate company, the net operating cash flow has a much bigger meaning than the net revenue, since so much of the company's expenses is depreciation, and that number actually isn't going down. Now, I'm going to go down to the capital expenditures. Now, here's a problem which is very hard to figure out the numbers, is in the first, almost all the first years, DHC put inside the capital expenditure all the things they bought. So they were buying every year, they're buying full of more assets. So the capital expenditure over here is 622 million. They bought more assets, 179 million, 137, 97. Only towards the last few years, they divided their capital expenditure and their cash flow statements into what they needed to do for maintenance, into the real estate they had, and what they acquired. So it's very hard to calculate the ROIC, the return on interest on invested capital, since we don't know exactly from their statements which invested capital was going into maintenance and which one is going into buying new properties. Now I want to get into the balance sheet. So we can see over here the total assets, and the total assets is mainly it's the PPE, all their land plus cash and a few other things, but it's mainly all their assets is their PPE. That's the main business. So in 2002 it was 1.1 billion, 1.2, 1.4. Slowly but slowly, we'll remember this number. In 2002 they started at 1.1 billion, and we'll go up to almost until the pandemic. We can see until 6.3 billion, 6.3, 6.3, 6.3, and here it started going down. They had to start selling assets. So 5.8, 5.7, and 5. So up until the pandemic, they were growing every year. They grew from 1.1 billion to 6.3. In 16 years, it's nice. From 1.1 to 6.3, that's 500%. It's a nice growth. We need to figure out from where the growth is coming from. And we go to the liabilities. So we'll go back here. In 2008, 2002, 378 million. The debt was 357. I'll just do the total liabilities right now. 548 million, 557, 558, 561. And the debt is growing. Well, again, we started at 370. And even now, in the pandemic, they had to sell things and pay back some of their debt. It grew up until 4 billion. So it grew at from 3.7,000%. The assets grew less than that, from 1.1 to 7. So we can see this thing right away, that their liabilities grew more than their assets. And we can see this in my spreadsheet. I'll put it inside here, where I put in between each year the difference from the year before. So we'll see over here, total liabilities from 2003 2002 went up 45%, and the total assets was up only 12%. So we ask ourselves, why did the liabilities go up 45% and the assets go up only 12%? And over here, it's a real occasion where it was the opposite, where the liabilities grew only 1.5% and the total assets grew 11%. Over here also, the liabilities went up 4.4% and the assets only 3.5%. You go to the next year, over here also sometimes they had a different. It went down 2% and the assets went up 5%. And the next year again, 90% the liabilities went down and the assets grew 90%. But most of the time, most of the years was the opposite. Over here we see liabilities went up 69%, assets were up only 46%. Over here, from 2009, the assets were up 90%, liabilities were up 42%. Liabilities were up 60%, assets were up 13%. 29% and 51%. So we can see almost every single year the liabilities were going up more than the assets. Now that shows something very, very simple. You see again, 51%, 25%. That's a huge difference. They added on 51% in their liabilities and the assets went up only 25%. That means something is wrong. So we can see the answer to this only by calculating the data. We can see this in the book value and in the earnings per share. So if we go back to 2002, the earnings per share was 89% and the book value was $13. And we'll see almost throughout the next entire 16 years, it didn't change very much. Earnings per share, 78, 89, 85, 91, $1, 90 cents, 90 cents, $1, 08, 08. It didn't grow. Like, there's no growth in the earnings per share, and there's hardly any growth in the book value. They started off in 2002. That's a few years after they went public. At $13, 12, 14, 13, 14, 15, 16, 15, 16, 15. There's hardly any growth in the book value and the earnings per share. And the reason for that is very, very simple. And we'll see how many shares they had. In 2002, 56 million, 58 million, 63, 68, 72, 83, 100. It's growing up. So we see how the company got its capital. So we can see until the last year. We have here in 2001, 237 million. So the company quadrupled its shares, and the book value hardly went up. And if we're looking at 2002 compared to 2021 compared to 2002, it went down. The earnings per share went down. So the company mainly, all its capital came from debt and from issuing shares. So the company didn't have a lot of internal growth. If a company would have been a growth company or a good company, they would have been buying more real estate from their growth, but they're not. They're earning very, very low volumes. They're not earning a lot of money on their properties. So mainly all the growth in their revenue and in their assets came from issuing shares and taking on more debt. They hardly had any internal growth. So they did have growth. In the next video, we'll start doing all the story of what's going on behind all the scenes. So they did have money, but they as a REIT, they were giving out a lot of their money in dividends. So over here, and one of my things I always do is retained earnings. I put inside how much each year, how much money the company retained in the company. So I left everything out because they did have retained earnings, but what they gave out in dividends, the distributions was higher than what they retained. So that's why I left it empty. So basically, when we see in the past almost 20 years in this company, so the first picture we get is like this. The company, its assets are growing very much, and also the liabilities. And the liabilities are growing more than their assets. And we see how the company was growing, not through internal growth, it was growing through issuing debt and through issuing shares. Taking on debt and selling out shares. That's from where they got their capital, that's from where they got money to buy more real estate. So it's not a bad, it's not a growth company, it's not a good company, it's not a company that's doing amazing. And if they would have kept their money inside and instead of giving out a dividend, so maybe it would have been a much better spot, but they gave it out. So it's very hard to do any ratios over here, because we're doing, let's say, return on assets. So return on assets, we're assuming that whatever the company is saying is right. Who said that their evaluation of their company, of their assets, is the right price? Maybe it's a wrong price. But okay, let's assume that their valuation is the right price. We'll just look through it. The return on assets, 2002, 4%, 3%, 3%. Not a big difference. It doesn't go up very much, doesn't go down very much until the pandemic hit. So it's more or less in between the three. Over here we got, this is 2014. So I'll go down from here, it'll be easier to see it. So 2, 1. So we see again, from 2002, things started to change. As I said already before, we saw that also in the gross margins. Since 2002, the gross margins went down. And in the next video, I'll get into what happened in around 2012, what changed then. So over here, we start seeing a decline in the return on assets. But the return on equity was actually going up. So return on equity in 2002 was 6%. 6% is more or less. And so more or less it's around 6% throughout the whole time. So there is one ratio which is very, very important in this case, as we're looking into a company which has a lot of problems, and we're looking to buy into it because it's selling at a 10 cents to a dollar. There is one thing that's very important to analyze, and that is how much times the company earned its ratios. So this is a ratio that I put into interest, how much time the company earned its interest. So over here they pay $27 million in interest. So the way I calculate this ratio is I don't take the net revenue but the operating revenue, because the operating revenues are the company is earning before its interest. I want to know how much money the company earned from its operations before it had to pay interest. So Ben Graham says that when you want to buy a bond, you should look for 3 to 4%, 3 to 4 times over. So if the company, let's say, paid an interest of $10 million, you want the company to be earning operating revenue of at least 3 to 4 times more than that. So we see actually that in the first years it was earning less. So in the first year it was earning basically 2.5 times its interest. So again, the net revenue was $50 million, interest paid was $27 million. So the company earned just a little bit more than double than what they were paying the interest. And this is actually a pretty good sign. So the numbers are actually going up throughout the years. 272, 300%. So, and when we get, again, this is something interesting. When we get here, 2012, 2013, so it's actually going up. And the interest rate is going up 325%, 400%, 400, and this is becoming into good territory. With the company over here, it's almost 5 times. So over here, the company paid 179 million in revenue, and the revenue is 286. So this is something very interesting because we want to see how strong the company is. Can it withstand its debt? So this is a very interesting thing. We see that even although the company wasn't having a lot of internal growth and most of its income was coming from debt and from issuing shares, they never really went down in how much times they were earning the interest. So even in the worst year we have here at 200%, it's times 2. They paid an interest of 41 million and their revenue was 56 million. That isn't a good sign at all, but that was the worst year. So this is a pretty good indication the company wasn't it didn't change its management throughout all the years. They're basically doing the same thing the whole time. The way they were growing and the way they were managing their debt, the way they're managing their assets. So this is just the first glimpse we're getting of the company, of its revenue, of its assets, of its liabilities, the book value, the earnings per share. So we can conclude more or less like this. The company didn't have a lot of internal growth since they were giving a lot of money in dividends. They were a REIT, they are a REIT, and most of their income was going out to the shareholders. So the way the company was growing was by issuing more shares and by taking on debt, buying more properties, and they were pretty conservative. I mean this in a good way. I mean, they were pretty steady the whole time, the way they were growing. They were same strategy the whole time. They're getting in more capital, buying more assets, taking on liabilities, buying more assets, taking on liabilities, buying more assets. Everything was more or less going in the same way since 2002. That's where I had my first data until 2012. In 2012, something changed. We can see something change, and it's basically we can see in the gross margins. We see that the percentage of the gross margins went down in 2012 from being from 35 to 40%. It went down to around the 20%. That was the first thing we see different in the company in 2012. And when the pandemic hit, that's when things went really south. And that's very simple because their main business is from senior homes. And senior housing got hit really, really hard in the pandemic. All the regulations, people couldn't go in, people couldn't go out. Everything was crazy. All the expenses went up. And so we don't see here anything that really, really changed in the company besides the pandemic. So just from looking at the numbers, we can say this company more or less got hit very hard by the pandemic. And if you want to bet that things will go back to normal, so, okay, that's something to look into it. We need a deeper analysis. Thank you very much, and I hope you enjoyed this video.